David R. Guttery is an investment advisory representative of Emeritus Investment Corporation and president of Keystone Financial Group in Trussville, Alabama. Please stay tuned through the end of the video for additional important disclosure information.
Today I'm joined by David Guttery, president of Keystone Financial Group in Trussville, for a discussion about the end of the year tax and financial planning ideas. Good morning, David. How are you doing today?
Very well.
Thank you for joining us.
Thank you for having me.
David, I'm sure that many of our viewers would be interested in hearing about what they should consider as the year draws to a close to minimize the impact of taxation in 2017. Please tell us about some of the strategies that you've used with your clients.
As the year draws to a close, it's always a good idea to evaluate any options that you might have to maximize tax efficiency for the year. I'd like to preface the following comments by strongly suggesting that you should consult with your tax advisor before adopting any of these strategies to ensure that they're suitable for your situation. At the end of every year, I help many clients evaluate the benefit of loss harvesting. And this involves the sale of securities within which you may be carrying a long or a short-term capital loss. Sometimes it can be beneficial to sell these positions and recognize the loss so that you can also sell an offsetting position in a security within which you have a short or long-term capital gain. In the event that you have no gains against which to deduct the losses are limited to $3,000, and any overage can be carried forward into future years. Otherwise, losses offset as much gain.
That sounds like a strategy that could be useful to many people. David, what about people who invest into retirement plans, such as a 401k or an IRA? What should they consider as the year draws to a close?
For 2017, individuals may defer up to $18,000 into a 401k, and if they're over 50, they have a $6,000 catch-up provision that would allow for a combined deferral of $24,000. Participants should check with their plan administrator to determine if they have room and the ability to make contributions to the plan, which would maximize their pre-tax deferral limits before the 31st of December. Now, for holders of IRA accounts, you have until the 17th of April 2018 to maximize deductible contributions for 2017. If you're younger than 50 and not subject to a phase-out, then you can contribute and deduct $5,500. If you're over 50 years of age, then your limit is $6,500. For those with access to non-qualified deferred compensation plans, I would encourage you to explore those opportunities as well.
David, do you have any advice for avoiding mistakes that could prove costly from a tax standpoint?
Yes. Investors should be careful when purchasing new shares of mutual funds within a non-qualified brokerage account as the year draws to a close. Mutual funds can declare relatively large distributions of dividends, short and long-term capital gains at the end of the year. If you've purchased new shares of non-qualified mutual funds just before such distributions are declared, then you will receive them and incur the tax upon them in the last month of the year. So my advice is to research any year-ending purchases for such pending activity before accidentally locking into a potential tax liability. Also, participants in a flexible spending account must be mindful that all money contributed to such FSAs must be spent before the end of the calendar year, or the residual balance is lost. Therefore, I always recommend that clients evaluate the balance that might exist around the 1st of December within such accounts relative to their known expenditures in the month of December. If it appears that you might not have enough to claim against the balance, then consider refilling January's prescription early, or buying extra sets of contact lenses if you use them, in order to make use of that money by the end of the year.
Indeed, those are important things to keep in mind. I assume that you encourage clients to consider charitable contribution opportunity as well, correct?
Yes. Making charitable contributions is a fantastic way to be of benefit to others and yourself at the same time. Generally, up to 50% of your adjusted gross income can be deducted when you give it to a public charity and certain private foundations. In other circumstances, Contributions may be limited to 30% or 20% of your adjusted gross income, depending on the nature of the entity receiving the gift.
Thank you, David. For additional information, David may be reached through the means listed upon the following screen. For the Trustville Tribune, I'm Chana Friday.
David R. Guttery independently offers securities and investment advisory services through Emeritus Investment Corporation, member FINRA and SIPC. AIC and Keystone Financial Group are not affiliated. Additional products and services may be available through David R. Guttery or Keystone Financial Group that are not offered through AIC. Some of the products and concepts discussed have their own cost and are subject to risk, including the possible loss of principal. These costs and risk will be thoroughly discussed with you prior to any recommendation or solicitation. Past performance is no guarantee of future results.